So we'll look at an example to understand the accounting issues in a little more detail. So consider, for example, that a US firm sells goods to a company located in Europe for euro 20,000, and this transaction is done on 1st of December. The spot rate at this time is $1.5 per euro. So right at this moment, that is on December 1, the US firm has accounts receivable of 20,000 into $1.5 per euro, that is equal to $30,000. Since the rate is 1.5 per euro today. This payment, however, is due in 45 days, and the balance sheet date, that is December 31st, the euro has appreciated to $1.55 per euro. So this is referred to as the balance sheet date. And on this date, the company will have an accounts receivable that would be revised up to a value of 20,000 into 1.55, that is 20,000 into 1.55, $31,000. So on the balance sheet date, the accounts receivable in US dollar terms or in US dollar books would be $31,000, and there would be gain on receivables that will be reported on the income statement to the tune of $1,000. However, the payment is due 45 days from now. So the payment is due on January 15th, at which point the euro has depreciated to only $1.4 per euro. So against this receivable of $31,000 that was reported on December 31st, what is the actual amount that the US firm would receive? So the actual receipt would be 20,000 into 1.4, that is $28,000. Hence, the firm now will knock off this accounts receivable. Since nothing else is receivable, all the money has come, and in the next year it will have to take a loss on receivables or write-off on receivables to the tune of $3,000. Since 31,000 was expected, we had already booked a gain of 1,000. Instead of that, we actually got only 28. So we didn't even get the earlier 30,000, we got only 28,000. So there was a loss on receivables to the tune of $3,000. So what we understand is that currency fluctuations can significantly alter the income statement and the balance sheet at the parent level or at the presentation level in US dollars. These gains and losses can often be a significant portion of a company's net profit or the total balance sheet, and hence the accounting needs to be understood in detail. An example: a US multinational firm has an Italian subsidiary. The subsidiary's functional currency is the euro. The subsidiary's books and records are maintained in euro. The parent's presentation currency is the US dollar. Determine which foreign currency translation method is appropriate. So it's an Italian subsidiary. The local currency is also likely to be the euro. The functional currency is also the euro. Records are also maintained in euro. So we need only apply the all current method to translate from the functional currency into the presentation currency. So from euro, we need to translate to the US dollar, and since this is the functional currency, the appropriate method would be the current rate method or the all current method. In the same question, what if the subsidiary's functional currency was the yen? So books and records are being kept in the euro, whereas the functional currency is the Japanese yen and the presentation currency is the US dollar. So we would first need to remeasure using the temporal method. And we would then need to translate into the presentation currency using the all current method. So euro is the local currency, yen is the functional currency, and USD is the presentation currency. So Gloria Incorporated is a US company with a subsidiary Maria PLC located in the United Kingdom. Maria was acquired by Gloria on December 31st, 2012. Gloria reports its financial results in US dollars. Maria's financial statements for 2013 are shown in the following two figures. So the assets side of the balance sheet is given. Please note these figures are in GBP or the British pound. The liability side of the balance sheet is also given. The income statement for 2013 is presented. And we are given the exchange rates between the US dollar and the pound. As on December 31st, 2012 as $0.6, December 2013 as $0.4 to a pound. Average for 2013 is given. Historical rate for equity, fixed assets, accumulated depreciation, COGS, depreciation is also given. It's been told that use the average rate to value ending inventory. The majority of Maria's operational, financial and investment decisions are made locally in UK. Although Maria does rely on Gloria for information technology expertise. Use the appropriate method to translate Maria's 2013 balance sheet and income statement into US dollars. So we see here that the functional currency is the same as the Great British Pound. And we need to convert from the British Pound, that is the functional currency, to the presentation currency, that is USD. So for translation from functional to the presentation, we use the current rate method that we just studied. So let's take a minute and quickly revise the current rate method. First, all income statement accounts are translated at the average rate. All balance sheet accounts are translated at the current rate except common stock, which is translated at the historical rate. Dividends are also translated at the historical rate. And a cumulative translation adjustment is recorded in the other comprehensive income as a translation gain or loss. So let's apply the current rate method and convert all of the statements from the British pound to the US dollar. We will start with the income statement first. So for 2013, the revenue was $4,000. COGS, gross margin, other expenses, depreciation and net income are all given. So translating the income statement is simple. All items are translated at the average rate. So we just need to look up the average rate and convert each of the items. So the average rate for 2013 is given as $0.5 per GBP. So we will multiply the GBP revenues by 0.5 to get the US dollar revenues. Similarly, the COGS, the gross margin will also be 0.5 since both revenue and COGS have been multiplied by 0.5. Other expenses, depreciation, and the net income in the current rate method would come out to be $250. The other accounts can also be easily calculated. Gross margin would be $750, $350 of other expenses, $150 depreciation, giving us a net income of $250. Let's now try to translate the balance sheet. So all asset accounts are translated at the current rate in the all current method. So we just need to look up the current rate to convert the asset accounts. The current rate that is on December 31st, 2013 is given as $0.4 per British pound. So we'll multiply the pound number by 0.4 to get to our asset values. So 300 into 0.4 and the total assets will also be multiplied by 0.4 to give us the total assets in USD, which will come out to be 3700 into 0.4, that is $1,480. We'll now move on to the liabilities side of the balance sheet. Just for reference, we'll note down that the total assets came out to be $1,480. Now all liabilities except common stock are also translated at the current rate. So we can translate the accounts payable, the current debt, the long-term debt, and hence the total liabilities by multiplying by 0.4. That will come out to be 2200 into 0.4 as $880. The common stock is translated at the rate applicable when the common stock was issued. So we'll look in the question for the exact rate at that time. The historical rate for equity is given to be $0.6 for 1 pound. So we'll multiply that by 0.6 such that the common stock comes out to be $480. The retained earnings will be calculated from the beginning retained earnings plus the net income minus any dividends paid. So in this case, there's a star that tells us that retained earnings on December 31, 2012 were $100. Please note this number is not relevant because it's in British pound and we need to translate the accounts into US dollars. So the beginning retained earnings are given to be $100. And we calculated the net income as $250 for 2013. Net income was $250. There were no dividends, hence the retained earnings at the end of the period would be $350. So the total assets were $1,480. And we can now compute the total liability as 880 plus 480 plus 350. So the total liability will come out to be equal to 880 plus 480 plus 350, that is $1,710. So we can see that there is some translation adjustment that needs to happen because the total assets are $1,480, whereas the total liabilities sum only up to $1,710. So the cumulative translation adjustment would be the total assets minus the total liabilities, that is 1480 minus 1710, that is equal to minus $230. In other words, in the translated balance sheet, there will be an other comprehensive income entry called cumulative translation adjustment. Which will be a number of minus $230. This is the number that makes the balance sheet match. So the assets are low and the liabilities are higher. It implies that we've lost $230 in translation because the assets are valued at lesser whereas the liabilities are valued at more, reducing our equity by $230. Please remember, the cumulative translation adjustment comes on the balance sheet. Translation adjustment does not come on the income statement in the current rate method. So we translated the income statement, net income of $250. We then translated the asset side of the balance sheet. That was pretty simple. Multiply all entries by 0.4, which will give us a total assets of $1,480. And we then translated the liabilities by multiplying all other liabilities by the current rate on the reporting date, the common stock by 0.6, that is the historical rate, and we calculated the retained earnings as the beginning retained earnings plus the net income minus dividends. The total assets and liabilities will normally not match. The difference is adjusted in a quantity called cumulative translation adjustment, which can be a gain or a loss. In this case, it's a loss of minus $230 to prepare the subsidiaries accounts in US dollars, that is the presentation currency. So it's the same example essentially, Gloria Incorporated being the US company, Maria PLC the subsidiary located in UK. The asset side is given to us in pounds, the liability side is given to us, the income statement is given to us. The exchange rates remain the same. We are now told to use the temporal method to translate Maria's 2013 balance sheet and income statement into US dollars. So again, we will start with the income statement. The revenue is given to be £4,000. Please note, the revenue and all other costs will be translated at the average rate. So revenue at the average rate, other expenses at the average rate. COGS, that is related to a non-monetary asset, will be translated at the historical rate. So would depreciation, that will again be translated at the historical rate applicable for depreciation. So let's go into the question and get these rates. The average for 2013 is $0.5 per British pound. The historical rate for COGS is given to be $0.455 and the historical rate for depreciation is given to be $0.458. So let's apply the rates and let's calculate the translated income statement. So revenue would be 4,000 into 0.5, COGS would be 2,500 into 0.455. Other expenses would again be at the average rate, so we'll multiply it with 0.5. Depreciation expense would be minus 300 multiplied by 0.458, that is the rate applicable for depreciation. This will now give us the net income before remeasurement gain or loss. So the net income still needs to be calculated. Please note there will be a remeasurement gain or loss that will come as we do our translation, which will be taken on the income statement in the temporal method. So the current calculation is the net income before remeasurement gain or loss. Let's try to calculate. The revenue will be $2,000. The cost of goods sold would be 2,500 into 0.455. That is $1,137.5. The other expenses would be minus $350, and the depreciation expense would be 300 into 0.458. That is minus $137.4. So the net income before remeasurement gain can be calculated as 2000 minus 1137.5 minus 350 minus 137.4. That is $375.1. So we've partially translated the income statement. We still need the remeasurement entry. We'll get that as we translate the balance sheet. So again, let's start with the asset side of the balance sheet. So remember, all monetary assets and liabilities are translated at the current rate. So for cash, we will apply the current rate. Accounts receivable, again the current rate. Inventory, that is a non-monetary asset, will be translated at the historical rate. Fixed assets, again at the historical rate. Accumulated depreciation, again at the historical rate for accumulated depreciation. That will give us the net fixed assets. So let's look at the current rate and the historical rate for inventory, fixed assets and accumulated depreciation. The current rate, that is on December 31st, 2013, is $0.4 per British pound. The historical rate for fixed assets is 0.46. For accumulated depreciation is 0.4665. And we are asked to use the average rate to value ending inventory. So cash will be translated at the current rate, that is 0.4. Accounts receivable, again at the current rate. Historical rate for inventory is the average rate, that is 0.5. The sum of these will give us the current assets. Please note, the current assets will be a mix of these rates now. We can't just multiply it with any one number. The historical rate for fixed assets is given to be 0.46, and the historical rate for accumulated depreciation is given to be 0.4665. Again, we can compute these and take the difference to calculate our net fixed assets. So let's calculate. The cash comes out to be $120. Accounts receivable comes out to be $320. Inventory comes out to be $750. If we sum these three up, we will get the current assets, that is $1,190. The fixed assets will be calculated as 1500 into 0.46. That is $690. The accumulated depreciation would be 400 into 0.4665. That is $186.6, giving us the net fixed assets of $503.4. So the total assets would be the sum of the net fixed assets plus the current assets. So that will be 503.4 plus 1190. That comes out to be $1693.4. So that's about translating the asset side of the balance sheet. Please note, it's not as simple as the current rate method, so there are different exchange rates that need to be applied for different accounts. Current rate for the monetary accounts, that is cash and receivables, and the historical rate for all other accounts. We'll now try to translate the liabilities. So we'll just take a note. The total assets came out to be $1693.4. Again, accounts payable, short-term debt and long-term debt will all be translated at the current rate. So these are monetary liabilities. They will be translated at the current rate, that is $0.4 per GBP. So we'll multiply this simply by 0.4. Since each account is multiplied by 0.4, the total current liabilities or total liabilities will also be multiplied by 0.4. That will be $880. The common stock would be translated at the historical rate applicable. So let's go and check that. Historical rate for equity is given to be $0.6 per British pound. So we'll multiply this with 0.6 and get the common stock as $480. This is the same calculation as before from the all current method. Now please note that in the temporal method, there is no translation adjustment happening on the balance sheet. So the retained earnings has to be a balancing figure. So whatever is this number, it has to make the balance sheet match, because there is no other entry at our disposal like the cumulative translation adjustment in the current rate method. So the total assets are $1693.4. The total liabilities plus common stock equals $1,360, giving us a retained earnings calculation of 1693.4 minus 1360, that is equal to $333.4. So the retained earning number has to be $333.4, otherwise a balance sheet won't match. The retained earnings, however, is the beginning retained earnings, which is given to be $100, plus the net income minus the dividends. There are no dividends in this case. So 100 plus the net income, that is the ending retained earnings, must be equal to $333.4. Or the net income must be 333.4 minus 100, that is equal to $233.4. So whatever is the net income that we have calculated hitherto has to be adjusted so as to make the net income equal to $233.4, since the retained earnings has to be $333.4. So let's see what the net income currently is. So it is a number of $375.1. We need to subtract a remeasurement loss so as to make the net income equal to $233.4. So the remeasurement loss will be calculated as 375.1 minus 233.4, that is $141.7, giving us a net income of $233.4. So with this, we have translated the income statement as well as the balance sheet successfully using the temporal method. So we translated all the income statement accounts and waited for the remeasurement gain or loss. We then translated the asset side of the balance sheet, calculated the number for the total assets, we then translated all the liabilities except retained earnings. The retained earnings has to be a balancing figure so as to make the liabilities match the total assets that we calculated previously. Once we have the retained earnings, we can back calculate what is the net income needed to get this retained earnings. So with the beginning retained earnings of $100, the net income needed is $233.4. Before any remeasurement, we have a net income of $375.1. To bring this number to 233.4, we need a remeasurement loss of $141.7. So this is how we apply the temporal method that is used to translate or convert from the local currency into the functional currency. So please recall, in the current rate method, the cumulative translation adjustment came out to be $230 minus the remeasurement loss in the temporal method came out to be minus $141.7. So if we compare the current rate method to the temporal method, the income before any translation gain or loss was $250 in the current rate method and $375 in the temporal method. The translation gain or loss in the current rate method was $230 minus, which was taken on the balance sheet. It was $141.7 minus, that was taken on the income statement. The net income isn't impacted by this translation gain or loss in the current rate method, so it remains the same as $250. For the temporal method, the net income after remeasurement became $233.4. The total assets were all at the current rate. In the all current method, they came out to be $1480. In the temporal method, the assets came out to be $1693.4. Please note, if a question comes on calculating any ratio or whether the ratio will increase or decrease, please note that it will all depend on the movement of the exchange rates and on the method that you will apply. So don't try to mug up any general trend or any formula that may be given anywhere. Just calculate the numerator separately or see how the numerator will be affected. Then calculate how the denominator will be affected. And you just need to follow the method that you've studied. To make a general conclusion on how that particular ratio will be affected, positively or negatively. Assume a foreign subsidiary was created on December 31st, 2012. The pound is the currency of the country where the foreign subsidiary is located. The subsidiary's balance sheets for 2012 and 2013 and the income statement for the year ended 2013 are as shown below. So cash, supplies or inventories, total assets and total liabilities for both years are given. In 2013, the revenue was $18,000. The revenue was 18,000 pounds. The expenses were 14,000 pounds, giving a net income of 4,000 pounds. There were no dividends, so this entire net income flew into the retained earnings, giving the ending retained earnings of $5,000. We are also given the price index. So in the beginning of 2013 it was 100 units. By the end it has become 140, and the average for 2013 was 120. Now, given that the subsidiary is in a hyperinflationary environment, restate the balance sheet and the income statement before applying the all current method. So we'll start with the balance sheet first. Cash is a monetary asset, so it will not be restated. For 2013 also, the cash would remain 10,000 in the restated balance sheet. The supplies have gone up from 23,000 units to 27,000 units, that is the British pound. So the supplies or the inventories need to be adjusted for inflation, and we need to calculate the current value. Now, strictly speaking, we should have been told as to what was the value of the index when the inventory was acquired. In this question, it is not given as to what was the value of the index when the supplies were acquired. So we will assume that they were acquired right at the beginning of the period, when the inflation index or when the value of the price index was 100. If you assume the average, that's also fine. In the question on the exam, it will be mentioned what was the price index when these supplies were acquired. So assuming that they were acquired at the beginning of the period, their value today, adjusting for the inflation of 40%, would be 40% higher, or it would be multiplied by 140 by 100. That is 27,000 multiplied by 140 divided by 100. That is $37,800. Summing up the two, we'll get the total assets as $47,800. The accounts payable won't change since it's a monetary liability, so this will remain $22,000. My apologies, it will be the British pound, not dollars, since we are first restating the accounts in pounds. So this will be 22,000 pounds. The common stock will be revalued based on the current value of the price index and the beginning of the period, or the contribution date if later. Since nothing is given about the contribution date for the common stock, which is the paid in capital plus the additional paid in capital that is directly gained from the shareholders, we will assume that, or we will take the beginning of period inflation index value. So we will multiply this 140 upon 100, which will give us a value of the common stock as $14,000. Now please note that the net purchasing power gain or loss is again taken in the income statement, something like the temporal method. So retained earnings is the only balancing figure on the balance sheet. So the total assets are calculated as $47,800, and the total liabilities are $36,000. That is the liabilities including common stock. Hence the retained earnings have to be a number equal to $11,800 so as to ensure that the balance sheet matches and the total liabilities and equity are $47,800, the same as the total assets. To come to the income statement, the revenues are $18,000 for 2013. Adjusting them for inflation, the current value of the revenue would be 140. Assuming that this revenue was also accumulated throughout the year, we would rebase it to 140 from an original of 120. That is, some sales would have been done at 100 levels and some sales would have been done at the end of the period at around 140 levels. So an average of 120 has to be taken up to a current value of 140. So both revenues and expenses are assumed to have happened equally throughout the year, such that to rebase them to the current index value of 140, we need to multiply by 140 by 120, which was the average for the period. So the revenue would come out to be 18,000 into 140 by 120. That is $21,000. The expenses would be 14,000 into 140 by 120. That is 1633. That is 16333.33. Or the net income before purchasing power gain or loss will be calculated as the difference between the two. Which comes out to be $4666.66. The retained earnings is fixed at $11,800. Once again, the retained earnings is nothing but the beginning retained earnings plus the net income minus dividends. Since there are no dividends, the net income has to be 11,800 minus 1,000. This is the ending value of the retained earnings and this is the beginning value of the retained earnings. My apologies, all units are in pounds, not dollars. So it will be 11,800 minus 1,000, that is 10,800 pounds. So if the net income has to be 10,800, there will be a purchasing power gain to the tune of 10,800 minus 466 minus 4,666.66 pounds. That is equal to 6133.33 pounds. So after the net income before purchasing power gain or loss, we will have a purchasing power gain or a net purchasing power gain as 6133.33 pounds, which will give us the net income as 10,800 pounds. This net income will then go into my retained earnings, and this will be the reconstructed or the restated balance sheet and the income statement adjusting for inflation. Please note that we had a purchasing power gain because we had net monetary liabilities. Our accounts payable was a much bigger number than our cash or than our monetary assets. So even if there is a lot of inflation, this accounts payable will still remain 22,000. We don't have to pay the other person more, whereas our assets will go up to the extent of the inflation. So our supplies, that is our inventory, will go up with inflation since it's a real asset, whereas the liability didn't go up because the liability was a monetary liability. It was something like debt or accounts payable. So remember, if we have a net monetary liability, we will gain from inflation. If we have net monetary assets, that is our liabilities were real and our assets were monetary, that is assets wouldn't revalue up, then we would have a loss. So we have to see that whether we have net monetary liabilities or net monetary assets. So we saw the total assets would be restated to 47,800. There will be a net purchasing power gain of about 6133 pounds. And please remember that holding monetary assets during inflation will result in a purchasing power loss. So if you're investing in bonds, then that's a bad thing because the value of the bond will go down as the coupons or the cash flows from the bond won't increase with inflation. If you're holding monetary liabilities, if you have issued a bond or if you've taken debt, then that is a good thing because the asset that you have purchased would increase in value with inflation, but your debt amount remains the same or your liability remains the same if it's a monetary liability. So we had a gain here because we had net monetary liabilities. If we had net monetary assets, we would have had a purchasing power loss because the purchasing power of our cash has gone down because of inflation. So we will first restate the balance sheet in pounds and then apply the all current method to give us the balance sheet and the income statement in the presentation currency.